The United Kingdom and Europe have not had a good year. War at their doorstep, concerns about energy supply, and the inflationary aftermath of stimulus measures have caused significant turmoil in these economies. At an individual level, citizens are facing a cost of living crisis as supply chains continue to falter. Interest rate hikes, designed to curb inflation, are doubling mortgage payments compared to the peak of the pandemic. Even before these complications, the UK was in a particularly vulnerable position, restructuring its economy post-Brexit to depend less on Europe and open up more to global trade with other countries. This plan could spectacularly backfire as the value of its currency collapses compared to the world reserve and its major potential new trade partner. On the other side of the English Channel, the situation is not much better. Like Britain lost the European Union lost Britain, the second largest economy in the Union, and a significant supplier of goods and expertise. These recent events have added to an already sluggish European economy, which had not experienced any real growth since 2008, affected by the financial crisis and subsequently the Eurozone crisis triggered by Greece. Then, of course, there were the controversial fiscal measures adopted by the new UK government, ostensibly aimed at combating inflation and the cost of living issues that come with it. However, as any high school economics student could tell you, they were as effective at taming the inflation bonfire as a bucket of gasoline. So could this be the start of the next Eurozone crisis that would stagnate the continent for another decade? Or are these simply symptoms of countries recovering from one of the most turbulent economic periods of the last few decades? To answer this question adequately, we must, as always, understand some important things. Why the economies of Europe and the UK are suddenly on the brink of collapse, how these economies could recover productively from these problems, and what future awaits them if they cannot. Once all of this is done, we can place the UK on the National Economy Explained leaderboard. The British pound has dropped about 30% since the beginning of the year compared to the dollar. However, it's crucial to address these concerns and see why this is not as bad as people make it seem. The value of a currency itself doesn't tell us much. The Japanese yen is worth less than 1/100th of a dollar, but that doesn't mean Japan is a failed state. The Kuwaiti dinar is worth more than 3 times the euro, but that doesn't mean Kuwait is an economic superpower. The pound has been losing value for decades, mainly because inflation in the UK has been consistently higher than in the US. In the UK, nominal wages are lower and nominal prices of things are lower, but when converted to US dollars, they have stayed more or less in line. Sometimes, having a currency close to parity with the dollar makes trade and tourism easier, as people don't have to do mental calculations for all their expenses. Another reason for the pound's slow fall is that fewer institutions hold it as a reserve of value. The dollar, yen, and more recently, the euro and yuan have gained importance as they are used in larger world economies than the UK. If central banks, governments, and major financial institutions hold a currency as a reserve asset, its value will be higher than if it's merely used as a means of exchange within an economy. As these institutions have gradually stopped relying on the pound, the currency has been traded in the forex markets, and supply and demand have done the rest. Another crucial factor is that many investors have been shaken by the prospect of a recession caused by the hangover from lockdowns, record inflation, and interest rate hikes by most central banks to combat inflation. If investors fear a downturn, they will sell their assets and get as much liquidity as they can to be ready to buy more assets when they feel markets have bottomed. The best type of currency to hold for future investments is the dollar. The pound has already fallen significantly against the dollar in the past, notably in 2008 at the start of the global financial crisis, for virtually the same reasons. Perhaps the easiest way to see that this drop in value is not necessarily due to the weakness of the British economy, but rather the relative strength of the US economy is to realize that most major currencies have fallen significantly against the dollar this year. One of the advantages of having a freely floating currency is that it acts as a global economic shock absorber. A lower pound and a lower euro make it cheaper for Americans to go on vacation in Europe or buy British exports or even invest in these economies, all of which will help cushion the blow these economies are currently taking. One of the big problems of the original Eurozone crisis was that Greece, Italy, and Portugal had debt issues, but were using the euro, meaning economically strong nations, particularly Germany and France, kept their currency value high and prevented this natural economic airbag from inflating. But that doesn't mean this can't turn into the next Eurozone crisis. While the drop in the value of the euro and the pound is easy to explain and even has some beneficial side effects, it's still not a great sign of the overall health of these economies. The long-term shape of Brexit is still unclear, the country is still recovering from the pandemic, and consumers, as well as investors, are on average going to avoid making significant purchases until they have a clearer view of what to expect in the future. There are also, of course, some new problems. The Russian invasion of Ukraine has further increased fears about the future economic prospects of both Europe and the UK. In response to its invasion, Russia received a series of economic sanctions designed to reduce its ability to sustain a prolonged war and harm its national economy. So it increased the pressure to end the invasion, but the economic problems in the UK and Europe are starting to make it seem that these sanctions are counterproductive. People are beginning to wonder if perhaps Europe needed Russia more than Russia needed Europe. Economic sanctions are somewhat like the geopolitical equivalent of radiotherapy. Restricting trade and currency flows harms all economies, but is done with the hope of hurting the economy, targeted by the sanctions more than the economies imposing them. And that is undoubtedly what is happening here. Russia is suffering the consequences of these sanctions much more than any other economy. However, we don't see it so directly because the country is effectively isolated from the outside world, and the media allowed to operate in the country are effectively only state spokespersons. But Russia deserves these problems, and local economic difficulties are no less real. The UK, in particular, had many high-level financial services industries created around working with wealthy Russians. London was always considered a safe place for Russians to keep their money, and that's why the city is full of multi-million-dollar townhouses owned by Russian oligarchs. These industries may have been detrimental to society in the long run, but for the economy at this moment, there are hundreds of companies and countless workers who depended directly on Russian money that is no longer entering the country. Of course, this issue is not as important or easy to understand as the repercussions that British citizens are experiencing. Energy and food prices are the most affected in Europe and the UK, and these are essential markets for everyone. Inflation in consumer markets disproportionately affects low-income households since food and energy make up a larger part of their budgets. It is understandable that the British government would want to offer assistance to these households to help them overcome these difficult times. However, the way they did it was a complete failure in basic economics. The new British Prime Minister took office at a challenging time, and the first item on the agenda was helping households cope with record inflation. This is an especially difficult problem for governments, because inflation is due to an excess of demand in an economy, insufficient supply of goods and services, or a combination of both factors. This means that citizens have to compete with each other for a limited supply, driving up prices. In reality, governments and central banks only have direct control over the demand side of this equation. In advanced economies like the UK and other European countries, most services and virtually all goods are provided by the private sector. The government cannot tell a company to produce more and cheaper because most companies try to maximize their profits by manufacturing as much as they can with the resources they have to sell to anyone in the economy with the means and desire to buy that product. In short, they're already doing everything possible to do exactly that. The government could give money to these companies to expand their operations, but that is a slow process. It can take years to build facilities and train staff to increase production. It also raises questions about which companies receive this money, which companies the government does not want to repay this money, and what happens if new facilities start producing goods after the supply has naturally been resolved. It is possible but very complicated. Normally, what governments do to influence production is change restrictions on companies and increase skilled immigration. However, most of the economic tools available focus on demand. This is a problem for the UK because the correct way for the government to deal with high inflation in an economy is to reduce spending and increase taxes. This reduces the amount of money the average worker takes home, meaning the economy as a whole has less purchasing power, causing total demand to fall, and companies are forced to lower their prices to attract customers. This is a difficult and politically unpopular stance for a government, even when an economy is doing very well. But it is much harder to do when an economy is on the brink of a recession, and implementing this contractionary fiscal policy would bring it to the edge of the abyss. Now, as you probably know, the British government did exactly the opposite. They launched a plan to cut taxes while offering subsidies to combat the cost of living issues the country is facing. I usually try to avoid judging economic decisions for political reasons. There is an argument that cutting taxes will increase people's net income, helping them cope with the cost of living crises the country is facing. However, it's a flawed argument. Increasing household incomes through tax cuts only exacerbates the rise in prices because there are now more pounds competing for the same amount of things. Worse yet, tax cuts disproportionately benefit higher incomes because they are the ones paying higher tax rates, but they are not the ones struggling with higher food and energy prices. Any economist would be able to tell this to policymakers. It's high school level economics. This means that the government was so poorly managed that they didn't even bother to ask, or they knew and didn't care because tax cuts were something they thought would be politically popular. Another confusing measure by the government was the decision to introduce strict price caps on household energy supply. We will, of course, analyze the economic reasons why this doesn't work. But before that, I think it's important to apply some common sense to demonstrate that it's not a good idea. The United Kingdom is facing high inflation, mainly due to the rising energy costs, and the government's solution was to outlaw losses. If this can work, why not outlaw price increases in all sectors? Well, because it doesn't work, at least not without significant side effects. If a company cannot charge the market price for an item, it will naturally reduce the quantity of that item it manufactures. If the imposed maximum price is not profitable, they won't produce anything. Energy providers buy energy packages from producers who still have to buy expensive natural gas or oil to generate electricity. Renewable energies can help, but they cannot provide all the energy demanded, especially at those artificially reduced prices. Usually, this causes a shortage of products and a black market of goods more expensive than if the market were left alone. But it is very difficult to sell electricity on the black market unless it is carefully controlled. The government may need to directly subsidize this price cap in practice by paying suppliers the money they need to continue producing electricity. So, in essence, it has become another stimulus measure. The diminishing confidence that international organizations had in the UK was shattered by these political announcements. The common consensus among high-level economists was that this was the kind of policy expected from an underdeveloped economy with unstable leadership. Stability and confidence are crucial for the long-term prosperity of any economy, especially one going through economic difficulties. If people don't trust the direction of an economy, they are less likely to want to invest in it, less likely to establish trade relations, less likely for citizens to start careers, buy houses, and create value in an economy that could collapse at any moment due to mismanagement. If you've been paying attention to this story, you probably know that 2 weeks ago, the Bank of England, the central bank of the United Kingdom, had to intervene to save the British government bond market. The market was in free fall because the central bank, the government, and British pension funds were trying to sell government bonds in the open market simultaneously. The government was trying to sell bonds to raise money to help offset its fiscal deficits and other stimulus measures. The central bank was trying to sell bonds to take as much money out of circulation as possible to reduce inflation. Pension funds were trying to sell bonds to get cash to cover the investment loans they had taken. If everyone is selling something and no one is buying, the price drops. If the price of British government bonds falls simultaneously, it makes it more expensive for the British government to borrow money and makes it seem like the country is bankrupt. The Bank of England had to backpedal and start buying these bonds to prevent a total market collapse. The general news coverage has made the British central bank look like a hero who arrives at the last second to save the economy from certain collapse. But that's its job. They are above all the lender of last resort to prevent the economy from getting into too much trouble. Well done. The Bank of England has done its job. But the fact that it had to deploy the parachute in what was considered an incredibly stable advanced economy worries many people. At least for now, the country is still in a stronger position than Greece in 2011. However, if confidence in an economy evaporates, that position can change very quickly. Nobody can predict the future, and economists least of all. But when we talk about the possibility of another Eurozone crisis, I think it's crucial to remember that many of these economies have not yet recovered from the original Eurozone crisis. So another period of significant economic turbulence is likely to stall growth in the foreseeable future. We've talked a lot about government failures in making economic decisions, but it's easy to criticize from the sidelines. What are the best alternatives? The government is in a difficult position, no doubt. But the first thing you learn in emergency situations is that you have to help yourself before you can help anyone else. The best thing the British government could do right now is regain the value of its currency and address inflation. Recessions are bad, but they can be managed. The UK has many resilient industries, and there's no doubt they will suffer during a recession. but they will suffer more if double-digit inflation persists. If the government applied contractionary fiscal policy, like taxing more and spending less, along with the Bank of England's own contractionary monetary policy of raising interest rates and withdrawing cash from circulation, it would send a very strong message to the global economy while increasing the value of the pound. If people and businesses need more pounds to pay their taxes or make interest payments, the demand for these pounds would increase. If, at the same time, the Bank of England were allowed to withdraw cash from circulation again, the supply would decrease. This would hurt local industry and increase unemployment, but it is the bitter medicine the economy needs right now. If the pound regained its value in the short term, it would counteract much of the economic pain inflicted by these measures because imported food, energy, and other essential products would be cheaper to buy with a stronger currency. At the moment, the government is pushing policies to stimulate economic growth at the expense of inflation, while the central bank is pushing policies to curb inflation at the expense of economic growth. It is counterproductive, and the only thing that can happen is that growth remains low and inflation high. In the last decade, UK growth has been flat, and with these new economic challenges, it's likely to remain so. Surprisingly, it hasn't started to decline, apart from the sharp drop during the early pandemic lockdowns. Finally, the industry of financial services are one of the largest industries in the UK and also one of its major exports. The weakness of the pound, combined with ongoing uncertainties about the long-term impact of Brexit, means that this sector and similar services will face challenges. It's a highly advanced economy with a lot of talent and capital, so it's not going anywhere. But it's not what it used to be. Thanks for watching, guys. I hope you enjoyed the video. Please leave a comment. Also, please consider liking and subscribing. I would really appreciate it. Thanks.